Imagine a world where you never actually buy your own groceries again.
Right, like never.
Yeah. Instead, a line of code living on your smartphone notices you're out of milk. And, that line of code silently reaches out across the internet.
It's completely in the background.
Exactly. It negotiates the price of milk with, another line of code at your local supermarket. It verifies your identity, executes the payment, and coordinates the delivery. And it does all of this in a matter of milliseconds.
While you're asleep.
Right, all while you're asleep. I mean, it sounds like pure science fiction, but according to the Q2 2026 earnings transcript of this massive financial infrastructure company called Global Payments, that reality isn't just, on the drawing board.
No, it's already in live pilot testing.
Yeah.
Which is just wild to think about.
It really is. Welcome to Talk Tickers, where we do these deep dives into corporate earnings. And what's fascinating here is that, most of us go through our entire lives completely oblivious to the digital plumbing that makes modern commerce possible.
Oh, totally. I mean, we tap a piece of plastic against the glass screen, the screen beeps, we grab our coffee, and we just walk away. We don't think about the labyrinth of routing protocols and security handshakes happening in those 2 seconds.
Right, and today we're looking at the company that actually builds that labyrinth. That's exactly what this deep dive is all about.
Yeah, because you might think a corporate earnings call is just, this dry, monotonous recitation of spreadsheets, executives reading decimal points.
But if you know how to read them, these transcripts are basically real-time diaries of the global economy. So today, we're translating all that Wall Street jargon into the real-world story of how money actually moves.
We are cracking open the Q2 transcript for Global Payments, which trades under the ticker GPN.
We've got a mountain of notes, articles, and their actual raw call transcript right here. But before we get into the weeds of artificial intelligence negotiating grocery prices, set the stage for us. Just how big of a player is Global Payments?
So to give you a 30,000-foot view, they are a colossal engine of global commerce. I mean, they operate at a scale where they process a massive percentage of the world's daily transactions.
Billions of dollars.
Exactly. Billions flow through their architecture every single day. And to understand their current position, you have to know that they recently completed this monumental integration with Worldpay.
Which was huge news.
It was a tectonic shift in the payments industry, combining two absolute giants. And now, as we're learning from this Q2 transcript, they're actively reorganizing this newly combined empire to better capture how the modern world actually buys and sells.
So they're essentially rebuilding the engine of the plane while it's flying at 30,000 feet?
Basically, yeah.
But, we can't talk about their futuristic AI or their grand architectural plans until we look at the immediate reality of their Q2 performance. Because the headline numbers they reported present a really interesting puzzle.
They definitely do.
And there's this geopolitical butterfly effect hidden in these numbers that we absolutely have to unpack for you.
For sure. The core financials for Q2 paint a picture of a highly resilient machine. But you're right, the numbers require some translation. Because Global Payments pulled in an adjusted net revenue of $3.16 billion.
Okay, wow.
Yeah, and on a normalized basis, excluding dispositions and other noise that represents a 4% growth rate. Meanwhile, their adjusted earnings per share, or EPS, hit $3.46.
Hold on, stop right there. I want to pull the emergency brake on the Wall Street terminology because we're throwing around a lot of terms that sound impressive but kind of obscure what's actually happening.
Fair enough.
First, when you say normalized basis, excluding dispositions, what does that actually mean in plain English?
That's a great catch. So a disposition is just corporate speak for selling off a piece of your business.
Okay.
Let's say you own a bakery and you also own a delivery truck. If you sell the delivery truck to someone else, you suddenly have this big influx of cash this year from that sale. But next year, you won't have that truck to sell again. So if an analyst is trying to figure out how healthy your actual baking business is, they have to remove the money you made from selling the truck. That's what normalizing means. Global Payments sold off some non-core assets. So to get a true apples-to-apples comparison of their actual payment processing business, management strips away the noise of those one-time sales.
Okay, that makes sense. You take out the garage sale money to see what your real paycheck is. So
Yep.
Stripping out the garage sale, their core business grew its revenue by 4%.
Exactly. But here's the other half of the equation. Their adjusted earnings per share So the actual profit attributed to each individual share of stock grew by a massive 12%.
Wow.
Yeah, and to cap it off, their adjusted operating margins expanded to 42%, which is a 70 basis point expansion.
Okay, let's unpack this. Because to anyone listening closely, this feels like a massive contradiction. It feels like financial magic.
It does seem weird at first glance.
Right. How does a company only grow the total money coming in the door by 4%, but somehow spike the profit per share by 12%?
Well,
And wait, before you answer that, you have to translate basis points for us because I refuse to let us sound like an audio textbook.
yeah, fair enough. Let's start with basis points. A basis point is literally just 1/100th of 1%.
Yeah.
It's a way for finance people to talk about very tiny changes without getting lost in decimals.
Okay.
So 100 basis points equals 1%. When management says their operating margin expanded by 70 basis points, they just mean their profit margin went up by 0.7%.
Okay, 0.7% doesn't sound like a lot to a normal person. But when your revenue is $3.16 billion a quarter, 0.7% is like tens of millions of dollars dropping straight into your pocket.
Precisely. And that margin expansion is the first answer to your question about the seeming contradiction between 4% revenue growth and 12% earnings growth. There are two primary levers of corporate finance at play here. The first lever is that margin expansion. When Global Payments integrated with Worldpay, they unlocked what analysts call synergies.
Ugh, another corporate buzzword. Synergies usually just means firing people, doesn't it?
I mean, often, yes, it includes headcount reduction, but in a tech integration of this scale, it's so much more than that. It means shutting down redundant data centers.
Ah, I see.
Right, like if Worldpay had a contract with Amazon Web Services for cloud hosting, and Global Payments had a separate contract, they can combine them and negotiate a massive volume discount.
That makes sense.
It means consolidating their customer service software licenses. By eliminating overlapping costs, they gain operational leverage.
So they're just running a tighter ship.
Exactly. So even though top-line revenue only grew by 4%, they're keeping a much larger percentage of every single dollar that comes in the door. The pie might be growing slowly, but the amount of the pie they get to actually eat is growing much faster.
Right, they're operating leaner. But I know that's only half the story. The other lever driving that 12% earnings spike is share buybacks.
Yes, it is.
And I have to push back here because whenever I hear a company boasting about massive share buybacks, I get skeptical. I mean, in this quarter alone, they repurchased approximately 8 million shares for $550 million.
That's a lot of money.
The underlying business is only growing by 4%, but you buy back millions of shares to artificially shrink the denominator. Aren't you just masking weak top-line growth?
That is the eternal debate in corporate finance right there. And it's a very valid critique. If a company is borrowing money at high interest rates just to buy back stock and pump up the share price so executives can cash out their bonuses, yes, that is destructive financial engineering.
Right, we see that happen.
But if we connect this to the bigger picture of Global Payments' balance sheet, that's not what's happening here. They're generating massive amounts of free cash flow, literally billions of dollars a year in pure unencumbered cash. They have to do something with it.
They could invest in new products, though, or, lower prices for their customers.
They could. And as we'll see when we get to the Genius platform and their AI investments, they are pumping hundreds of millions into research and development.
Okay, fair.
But once you have fully funded all your profitable growth initiatives, what do you do with the leftover $500 million sitting in the bank every quarter?
I guess you give it back.
Yeah, you can pay a dividend or you can buy back stock.
Yeah.
By retiring those 8 million shares, they permanently shrink the total number of shares in existence.
So fewer slices of the pie.
Exactly. So even if the total net income of the company only grew moderately, you're dividing that income by a significantly smaller number of shares. There are fewer people sitting at the dining table, so every remaining shareholder gets a much larger slice.
It's a highly efficient way to return value to the owners of the company, provided the stock isn't wildly overvalued. I'll grant you that they aren't just papering over a dying business.
Right.
But let's look at why that revenue pie only grew by 4% in the first place. Because reading through the transcript, management spent a lot of time pointing the finger at geopolitics.
They did.
They specifically called out a 100 basis point, so 1% revenue drag caused directly by the ongoing conflict in the Middle East. And I have to admit, as a consumer, I was totally blindsided by this.
A lot of people were.
Why does a global payments processor sitting in Atlanta care so much about a regional conflict? Is it just lost sales from coffee shops and retail stores inside that specific war zone?
That's the intuitive guess. Most people assume it's just a localized drop in consumer spending. But the reality of global commerce is much more complex, and it has to do with the sheer scale of global payments travel portfolio.
The travel portfolio.
Yeah. It's not just that fewer people are physically swiping cards in the Middle East. It's about a fundamental structural shift in global airline capacity.
Capacity. You mean the planes themselves, like where the metal is actually flying?
Precisely. The CEO, Cameron Bready, noted that airline capacity and forward bookings within their travel portfolio remain significantly below pre-conflict levels.
Okay.
What happens during a prolonged regional conflict is that airlines are forced into crisis management. They don't just ground their planes and leave them sitting on the tarmac. They reallocate those assets to safer routes.
Right. They have to keep them moving.
So an airline takes a massive Boeing 777 that was scheduled for a long-haul international route, say a flight from New York to Dubai or London to Tel Aviv, and they reassign that plane to shorter-haul domestic or intra-European routes.
But wait, if the plane is still flying and people are still buying tickets to fill those seats, why does global payments lose money? A swipe is a swipe, right?
No, and this is a critical misunderstanding of how the payment industry works. All transactions are not created equal. The sheer volume, the number of tickets being bought, might still exist, but the yield on those transactions plummets. Let's break down the mechanics of a cross-border transaction.
Yes, walk me through the toll booths. If I buy a $2,000 ticket from New York to Dubai, who gets paid?
When you buy that international ticket, it's a high-ticket item. But more importantly, it often involves complex cross-border payment processing.
Okay.
If you use a U.S.-issued credit card to buy a ticket on an airline based in the UAE, the transaction has to cross multiple regulatory jurisdictions. It involves currency conversions.
Oh, right, the currency stuff.
The credit card networks, Visa or MasterCard, charge higher cross-border assessment fees. The banks involved take a slightly higher cut for the increased fraud risk of an international transaction.
And global payments is in the middle of all that.
Exactly. Because they sit in the middle of all this routing and risk management, they take a percentage of that very large, very complex pie. The profit margin on that single swipe is incredibly high.
So it's a massive cash cow for them.
Exactly. Now, compare that to the alternative. The airline moved that plane, and instead of selling one $2,000 ticket to Dubai, they sell 10 $200 tickets from Chicago to Atlanta.
Ah, I see where this is going.
Right. Those are domestic short-haul flights. There is no currency conversion. There are no cross-border assessment fees. The fraud risk profile is completely different.
So it's way cheaper to process.
The underlying payment economics are drastically simpler and much lower margin. So the airline is still flying and consumers are still traveling, but the profitable, high-yielding transactions have essentially evaporated from the system.
That is absolutely wild. That 1% drag on their entire global revenue proves just how incredibly interconnected global commerce really is.
It really does.
Like a route cancellation in one hemisphere driven by geopolitics literally forces a financial tech giant on the other side of the planet to rewrite their quarterly earnings expectations.
Yeah, it's a direct hit.
And obviously, we're impartially reporting the numbers here. We aren't taking a stance on the geopolitical conflict itself, but it really underscores the fragility of global supply chains.
Right.
We always think of supply chains as physical things, cargo ships and shipping containers, but there's a digital supply chain too, and it's just as vulnerable to real-world shocks.
That's a brilliant way to frame it. The digital supply chain is inextricably linked to the physical movement of assets. And if the physical assets, the airplanes, change their behavior, the digital toll booths collect fewer tolls.
Which begs the question, if this highly profitable travel segment is under severe pressure, how is global payments offsetting this loss and still managing to grow?
That's the billion-dollar question.
Right. And to understand that, we have to look at how they just completely rewired their internal architecture.
Yes, the architectural shift is arguably the most important long-term takeaway from this call. It's the foundation for everything else they're trying to achieve.
Okay, walk us through it.
Management officially detailed their transition to 3 brand new reporting segments. Going forward, the entire massive enterprise is broken down into SMB, which stands for Small and Medium Business Enterprise and Platforms.
Now, I've worked in the corporate world, and I know that reorganizing a company of this size is a colossal headache. It requires endless meetings, reassigning thousands of employees, changing compensation structures, and rewriting all your software dashboards.
It's painful.
Why go through the agony of ripping up the org chart and starting over?
Because if you don't align your structure with your customer, you eventually die. This is not just accounting semantics or a cosmetic reshuffle for the sake of a slide deck.
It's functional.
Very. This restructuring aligns their direct sales teams, their product development engineers, and their underlying technology directly with how clients actually buy software today.
How did they used to do it?
Well, in the past, massive legacy payments companies often organized geographically. They had a North American division, a European division, and so on. Or they organized by specific legacy product lines.
Right, like the credit card terminal division and the online gateway division.
Exactly. But that structure is entirely obsolete. By aligning into SMB, enterprise, and platforms, Global Payments is tailoring its entire go-to-market strategy to the specific complexity of the merchant.
Give me an example.
Think about the needs of a local family-owned restaurant in the SMB segment. They need a simple, out-of-the-box solution that just works on day one. They don't have an IT department.
Right.
Now compare that to a multinational hotel chain in the enterprise segment. That hotel chain has thousands of locations, operates in 40 different currencies, uses proprietary property management software, and demands bespoke API integrations.
Totally different beast.
If you send the same sales rep with the same pitch deck to both of those clients, you will lose them both.
Oh, they're specializing. They're acknowledging that the product you sell to the local coffee shop is fundamentally a different species of software than the product you sell to an international hotel brand.
Precisely.
But a big part of making this new structure work involves their underlying technology. And this leads us to one of the most technical, but arguably most crucial parts of the transcript, the FIS separation.
Yes.
Because when Global Payments acquired Worldpay, Worldpay was essentially entangled with its former parent company, FIS. And management made a very specific point about pulling forward the technology separation work from FIS into 2026.
Yeah, the CEO noted that the sooner they can separate from FIS's technology environments, the sooner they can execute on their own operational plans without relying on external coordination.
Which makes sense.
To understand why this is so critical, you have to understand the concept of tech debt.
I love this concept. Let's explore it because I think it applies to everything from massive corporations down to organizing your personal laptop.
Absolutely.
I always compare tech debt to buying a beautiful new house, but leaving the previous owner in charge of the plumbing. You might technically own the walls, the roof, and the furniture. You can paint the living room whatever color you want. But if you want to install a new sink, or if a pipe bursts in the basement at 2 a.m., you can't just call a plumber. You have to call the old owner, ask them to come over, and wait for them to turn off the water main.
That is a perfect analogy.
Oh.
And in the fast-paced world of fintech, waiting for the previous owner to turn off the water main is a death sentence.
It has to be.
When two massive companies merge, their computer systems don't just magically shake hands and combine. They are tangled together like a massive bowl of spaghetti. Worldpay was historically tied to FIS's massive mainframe architectures and data centers.
So every little change was a hassle.
Huge hassle. If Global Payments wanted to launch a new feature, or roll out a security update, or change a routing protocol, they had to coordinate with FIS's engineering teams, adhere to FIS's release schedules, and likely pay FIS transition service fees.
Brutal.
Getting completely off the FIS technology stack quickly gives Global Payments total, independent operational control over the Worldpay environment. They get the keys to the plumbing back.
But ripping out the plumbing of a multi-billion-dollar financial system is incredibly expensive and highly risky. I mean, you're talking about migrating millions of merchant accounts and billions of data points without dropping a single transaction.
Right.
Why accelerate that massive headache into 2026?
Because of a brilliant piece of financial optimization highlighted by the CFO, Josh Whipple.
Right, the tax optimization. I read this in the transcript, and to a layperson, it sounds like an alien language. The CFO basically said that pulling these separation costs forward helps offset tax gains from prior divestitures. Please, translate that for us. How does spending a fortune on IT migration save them money?
Let's translate this into everyday terms. Imagine you, personally, Sell a piece of real estate, a second home, and you make a massive $100,000 profit on the sale. The government is going to look at that windfall and demand a huge chunk of it in capital gains taxes at the end of the year.
Right. The tax man always comes.
Always. But let's say you also own a business, and you know that eventually you're going to have to spend $80,000 to replace the entire roof of your warehouse. You were planning to do it next year.
Okay, I see where this is going.
Right. If you intentionally choose to do the roof replacement this year, the exact same year you made that $100,000 profit, you can deduct that massive business expense against your income.
Sneaky.
You're intentionally taking on a massive expense now to artificially lower your overall taxable income for the year, thereby shielding your real estate profits from the IRS.
So Global Payments made a bunch of money earlier by selling off non-core assets, those dispositions we talked about earlier. They have a giant tax bill waiting for them.
Correct.
But they also have this massive, painful IT migration they have to pay for eventually. By accelerating the IT migration and paying for it now, they write off the expense against their previous profits. They're basically taking their medicine now because the medicine is on sale.
Exactly. It's a classic example of turning an operational necessity into a financial optimization. By absorbing the pain and the cost of the separation now, they not only gain their operational independence faster, but they optimize their tax position in the current fiscal year. It's brilliant management of the balance sheet.
That really is. So now that we understand this new three-part structure and the independent tax-optimized foundation it's being built on, let's dive into the largest piece of that pie. The SMB segment.
Yeah, let's talk about SMB.
Because this is the small and medium business space, and it is an absolute battleground. We're talking about local restaurants, independent mechanics, boutique clothing stores. And specifically, I want to talk about the genius strategy that is driving this segment forward.
The SMB segment is the historical lifeblood of payment processing. It pulled in $1.51 billion in revenue for the quarter, which represents a 4% normalized increase.
Solid growth.
Now, to be fair, management did mention a slight softness in the UK market, acting as a macro drag on this segment, mostly due to localized economic pressures. But they didn't dwell on it because they quickly pivoted to the real star of the show, the Genius point-of-sale platform.
Yes, the numbers they rattled off for Genius are staggering, and this is where I think things get really tangible for you if you're listening. Genius bookings increased by 25% sequentially just from Q1 to Q2 of this year.
Massive leap.
And new merchant locations deploying Genius are up over 50% year over year. But this is the stat that blew my mind. Their sales force effectiveness improved by 30% per quota-carrying professional since the beginning of the year.
That's huge.
That means the exact same sales rep is suddenly closing 30% more deals just by having this product in their bag.
It shows that the investments they made in their go-to-market transformation are paying off. When your sales reps are that much more efficient, your customer acquisition cost drops dramatically. But the adoption rate is only part of the story. You can give a product away for free and get great adoption rates. The economics of Genius are what really matter.
Well, let's talk about those economics. Because there is one stat in the transcript that I immediately circled in bright red ink, and I'm putting my cynical hat on for this one.
Okay, let's hear it.
Management noted that new customer yields rose 75% year over year for Genius clients. I have to ask, are they just squeezing the little guy? Like, are they just price gouging small restaurants and mom and pop shops?
I get why you'd ask that.
Right, because if I own a coffee shop and my payment processor suddenly tells me I have to pay 75% more for my point of sale system, I'm going to be furious. Is there actual tangible value being delivered here to justify that kind of premium?
It's a completely fair question, and if they were just jacking up the swipe fees by 75%, merchants would be fleeing to competitors by the thousands. The payment space is too competitive for pure price gouging.
So what's the hook?
What's happening here is a fundamental shift in the value proposition. This raises an important question about what a point-of-sale system is actually supposed to do in 2026. Global Payments is able to command a 75% higher yield because they are no longer just selling a dumb terminal that reads credit cards.
Okay.
They've completely reinvented the hardware and the software to solve very specific, very expensive operational pain points for these merchants.
Okay, I'll play the skeptical restaurant owner. Walk me through the tech. What exactly does Genius do differently that justifies me paying you that much more?
Let's start with the physical hardware. They introduced new Edge AI handhelds for waitstaff.
Let's define Edge AI before we go further, because everyone throws AI into their marketing materials these days. What does the Edge part mean?
It is a critical distinction.
Yeah.
Most AI that we interact with today, like ChatGPT, is cloud-based. When you ask it a question on your phone isn't actually doing the thinking.
It's just sending a message.
Right. Your phone sends the question over the internet to a massive multi-billion-dollar data center in Virginia or California. The servers there process the data, calculate the answer, and send it back to your phone.
Which takes time.
Exactly. It creates latency. It might only be a second or two, but it relies entirely on a strong, uninterrupted internet connection. Edge AI flips that model.
How so?
Edge computing means that the artificial intelligence models, the actual neural networks making decisions, are running locally, right there on the microchip, physically located inside the device in the server's hand. It doesn't need to ping a cloud server across the country to process a command.
Oh, that makes a massive difference in a hospitality setting. If you're a waiter standing at a table of 6 impatient people, you can't stand there staring at a spinning wheel on your screen for 3 seconds, waiting for a cloud server to understand that the customer wanted no onions.
Precisely. The Edge AI eliminates internet latency entirely, and it goes further than just speed. These specific Genius devices use AI voice ordering technology that is fundamentally tuned for incredibly loud, high-noise environments.
Okay, picture a Friday night dinner rush. The kitchen is clattering, music is blaring, 50 people are talking at once. Voice recognition usually fails miserably in that environment.
Historically, yes.
Yeah.
But because the AI model is running locally on the edge and is specifically trained on the acoustic profiles of crowded restaurants, it isolates the server's voice.
Wow.
Yeah, a server can have a natural conversational interaction with a customer. I'll take the steak, medium rare, sub the fries for a salad, dressing on the side. And the Edge AI is silently and instantly building the complex ticket in the background without the server having to tap 15 different nested menus on a touchscreen.
That completely changes the choreography of the restaurant. I mean, if a server doesn't have to stare at a screen and tap buttons, they maintain eye contact with the guests, they can process the order in half the time. The restaurant owner is perfectly willing to pay a 75% premium for that system because the return on investment is immediate. It increases table turnover, drastically reduces costly order errors in the kitchen, and lets a single server handle more tables simultaneously without getting overwhelmed.
Exactly. You are paying for operational efficiency, not just a credit card swipe. But the hardware is only half the story. The back-end software is where the real justification for that yield increase comes in.
Right.
They launched something called Genius AI Reporting, which utilizes an agentic assistant. And this is where we really leave the era of traditional spreadsheets behind.
Right, the agentic assistant. Break this down for us, because data analytics used to be something only massive corporations could afford.
Historically, if an independent restaurant owner wanted to know what their most profitable menu item was on a Tuesday, or if they wanted to understand their labor costs versus revenue during a rainstorm, they had to act like a data scientist.
Which they don't have time for.
Exactly. They had to log into a complex dashboard on a back office computer, pull a CSV report, filter the data, build a pivot table, and create a chart. Most small business owners don't have the time or the skills to do that. They just run on gut instinct.
Which leads to terrible business decisions.
Right. But with the agentic assistant, they don't have to learn dashboard software at all. The interface is simply natural language. They can pull out their phone and literally ask the AI, like they're texting a manager, what was my highest margin appetizer during last night's dinner rush?
Just a simple question.
Or, how many servers do I need scheduled for next Sunday based on historical Mother's Day traffic?
Yeah.
The AI instantly queries the back-end data, surfaces trends, identifies patterns, and provides actionable operational insights in plain English.
It's like having a Wharton MBA data scientist on staff for a fraction of the cost. When you look at it that way, a 75% higher yield on the payment processing side feels totally justified because the merchant is essentially replacing multiple separate software subscriptions, scheduling, analytics, inventory, and they're replacing all those operational headaches with one unified platform. They aren't buying a payment terminal, they're buying an operating system for their business. And Global Payments isn't keeping this contained to a small direct sales team. What is their distribution strategy for Genius moving forward?
This is where the sheer scale of the Worldpay integration flexes its muscles. They are preparing to turn on a massive indirect distribution engine. Management announced that in the fourth quarter of 2026, they plan to unleash Genius onto 30 of Worldpay's largest financial institution partners.
Financial institution partners meaning retail banks.
Yes. Think about the life cycle of a new business. When an entrepreneur decides to open a bakery, one of the very first things they do is walk into their local bank branch to open a business checking account and secure a line of credit.
Makes sense.
Historically, the bank would open the account and maybe hand them a flyer for a generic credit card reader. Under this new strategy, when that small business goes to the bank itself will be actively pitching and selling the Genius platform to them, deeply integrated with their new banking products.
It's brilliant leverage. Global Payments vastly expands its distribution footprint and gets access to thousands of new merchants right at the moment of inception without having to hire, train, and pay salaries for thousands of new direct sales reps. The banks do the selling for them.
It is a highly efficient customer acquisition funnel.
So we have the SMB space, which is being fought and won with sleek physical hardware, edge computing, and voice-activated AI assistance. It's a very tangible physical battleground. But the enterprise and platform segments are playing a totally different game.
They are.
They aren't trying to build the coolest physical hardware. They're winning by making payments completely invisible. Let's look at the big players first in the enterprise segment.
The enterprise segment focuses on the true giants. Multinational clients with over $50 million in annualized volume. We're talking about global hotel chains, international retailers, massive franchises.
And how did they do?
The segment pulled in $838 million in revenue for the quarter, which is a 7% normalized growth rate. And it's crucial to remember the context here. The 7% growth was achieved despite absorbing that massive 400 basis point hit from the Middle East travel disruption we discussed earlier.
That implies the underlying non-travel business. The actual retail and food service side of the enterprise segment is growing exceptionally well to drag the overall average up to 7%.
It is. They highlighted a 10% year-to-date growth in enterprise bookings, meaning their enterprise sales teams are signing new massive contracts at a rapid clip.
Awesome.
And the names they are acquiring are marquee global brands. Shangri-La Hotels, Aldi, Morrison's in the UK, Careem, which is the major ride-sharing and everything app platform in the UAE.
And there was one specific deal that really caught my eye. They announced a massive exclusive deal with Domino's Pizza in the United States.
Yes. Global Payments will now handle both their physical in-store payments and their digital app-based payments.
The reason this is so significant is that Domino's is not really a pizza company. If you look at how they operate, Domino's is essentially a high-tech logistics and e-commerce company that just happens to sell pizza.
Very true.
Their app architecture, their routing software, their loyalty programs, it's all incredibly sophisticated. For a tech-forward company like Domino's to trust Global Payments with their exclusive U.S. business is a massive endorsement of Global Payments' underlying architecture. It proves they can handle extreme volume spikes like Super Bowl Sunday without crashing.
It is a major validation of their omni-channel capabilities, the ability to seamlessly bridge the physical world of the store with the digital world of the app on a single unified backend.
But if enterprise is about landing the whales, the third segment, platforms, is where the terminology gets a little dense, but the implications are massive. The platform segment did $628 million in revenue, also growing at a very healthy 7%. But within that, management called out explosive 25% growth in BOZ banking as a service and a 10% volume increase in embedded payments.
That's where the growth is.
Right. But this is where I need you to translate for us. What does PayFac mean? What are embedded payments? What does this actually mean for the software that you and I use every day on our phones?
Absolutely. The acronym PayFac stands for Payment Facilitator. To understand why this is a multi-billion-dollar shift, you have to look at the history of how commerce operates. Let's use a hypothetical example. Imagine a woman named Sarah who owned a gymnastics center back in 2015.
Okay, Sarah's Gymnastics in 2015.
Sarah had to stitch her business together. She bought scheduling software from one tech company so parents could book classes. She bought accounting software from a second company. And she signed a contract with a third company, a traditional payment processor, to put a physical credit card terminal on her front desk. She had 3 separate vendors.
And I can tell you from experience, none of those systems talk to each other. At the end of the day, Sarah had to sit at her desk, look at the scheduling software to see who came to class, look at the receipts printed from the credit card terminal, and manually reconcile the two into her accounting software. It was an administrative nightmare.
Exactly.
Yeah.
It was incredibly inefficient. But business owners like Sarah don't want that anymore. The secular shift in the industry is vertical software.
Vertical software?
Yeah, Sarah wants to buy one piece of software that runs her entire gymnastics, business scheduling, payroll, marketing, and payments all in one place. And more importantly, she wants the payment processing to just automatically happen in the background. She doesn't want a separate terminal. That is what embedded payments is.
So instead of Global Payments trying to sell a terminal directly to Sarah, what do?
They go to the software company that builds the gymnastics app. In the transcript, management specifically mentioned a software company called Explore, which provides management software for gyms, childcare centers, and health clubs. Global Payments integrates their technology directly into Explore's codebase via APIs. So when a parent pays for daycare through the Explore app on their phone, the money moves instantly.
But the parent doesn't know they're interacting with Global Payments.
Never. The parent only sees the Explore brand, or Sarah's daycare brand. Explore is acting as the payment facilitator, the PayFac. Explore owns the front-end relationship with the daycare center and the parent.
Ah, I see.
But Global Payments is the invisible plumbing behind the scenes. They provide the underlying regulatory compliance, the connection to the Visa and MasterCard networks, the complex money routing, and the fraud infrastructure. Businesses want payments to be invisible.
The analogy I like to use for embedded payments is a theme park magic band. Think about walking around Disney World. You aren't reaching into your pocket for your physical wallet every time you want to buy a churro or get on a ride.
Right, you just tap it.
Exactly. The environment just knows you have a pass. The transaction is fictionless. It's embedded into the environment itself. Global Payments is essentially trying to turn the entire internet into that theme park. They're wholesale distributing their payment rails to thousands of different software companies who then bake it deeply into their own apps.
That is exactly right. And it leads to incredibly sticky revenue for Global Payments, because once a software company embeds that plumbing into their core code, they almost never rip it out. It is too difficult to change.
Okay, so that's embedded payments. But what about that other acronym, BaaS, Banking as a Service, which they said grew by a massive 25%. How is that different?
If embedded payments is letting Sarah, the gym owner, process credit cards invisibly, banking as a service takes it a massive step further. BaaS allows Explore, the software company, to offer actual banking products directly to Sarah.
Wait, Explore isn't a bank, they're a software company.
Exactly. But with BaaS, provided by Global Payments, Explore can say to Sarah, hey, instead of taking the money you make on our app and transferring it to your Chase or Wells Fargo checking account, why don't you just open a business checking account directly with us?
Oh, wow.
We will give you an Explore corporate debit card, and we will lend you money to buy new gymnastics equipment based on your cash flow.
So the software company effectively becomes the bank. But again, Global Payments is the invisible plumbing, making it legally and technically possible. They provide the banking licenses, the ledger technology, and the regulatory compliance.
Precisely. Every company wants to be a fintech company now,
Yeah.
And Global Payments is selling them the pickaxes and shovels to do it.
That is fascinating. But here's where we take a massive leap into the future. Because according to this earnings call, this invisible plumbing isn't just passively processing credit cards or holding deposits anymore. It's actively making highly complex, real-time decisions. And that brings us to the most futuristic sci-fi part of this Q2 deep dive, the deployment of artificial intelligence at a massive scale.
This is where the sheer volume of data that Global Payments possesses becomes an insurmountable competitive advantage. Artificial intelligence is only as smart as the data it's trained on.
Naturally.
Because Global Payments sees billions of transactions across every industry on Earth, their models are incredibly sophisticated. Management spent a lot of time discussing a specific product called their Revenue Boost solution.
Yes, let's look at the numbers they gave for Revenue Boost. They stated that by using AI-powered intelligent decisioning, Revenue Boost is delivering an additional 50 basis point increase in transaction approval rates.
Which is huge.
Right. But as we established earlier, 50 basis points is half of 1%. To the average person listening, increasing an approval rate by 0.5% sounds incredibly tiny. Why did the CEO specifically highlight such a microscopic improvement on an earnings call?
Because we have to contextualize the math of scale. Global Payments processes hundreds of billions of dollars. In the payment processing world, the enemy is something called a false decline.
Explain the mechanics of a false decline. What is actually happening in the network?
A false decline happens when a legitimate customer tries to buy something, but the system incorrectly flags the transaction as fraud, and blocks it. Let's say you live in New York and you always buy your coffee in New York.
Okay.
One day you fly to London for business and you try to buy a $2,000 laptop at an electronics store. The legacy, rules-based fraud systems look at that transaction and panic. They say, this card is normally used for $5 coffees in Manhattan and now is trying to buy a $2,000 computer in London. Block the transaction.
It's infuriating as a consumer. You have the money, it's your card, and you have to stand there awkwardly while the terminal says declined.
It is the worst possible user experience. And financially, everyone loses. The merchant loses a massive sale. You, the consumer, are frustrated and embarrassed. And the payment processor, who only gets paid a fee if the transaction clears, gets absolutely nothing.
It's a lose-lose-lose scenario.
Right. But by using advanced neural networks and machine learning, Revenue Boost analyzes hundreds of subtle data points in milliseconds. It looks at the device ID of your phone, your biometric typing speed, your historical travel patterns, and millions of other hidden variables.
It sees the big picture.
It can confidently distinguish a true fraudster from a legitimate purchase in a way that rigid rules-based systems cannot.
So the AI says, yes, this is a weird location, but the device ID matches his usual phone, and he bought an airline ticket to London 2 days ago on this same card. Let the transaction through.
Exactly. And at the scale of hundreds of billions of dollars, saving those falsely declined transactions, increasing approvals by just 0.5%, translates into massive, frictionless, basically free revenue for the merchants, and millions in pure profit for global payments. It's pure optimization through artificial intelligence.
Optimization of existing systems is great, and it clearly drives the bottom line. But here's where it gets really interesting, because the CEO, Cameron Bready, didn't just talk about background optimization. He explicitly used a phrase that I had to rewind the transcript to listen to again.
Agentic commerce.
Yes, he called out agentic commerce. He described it as a massive emerging growth opportunity and confirmed they already have live pilots underway with major retailers and AI platforms. And this blew my mind. Wait, so an autonomous AI agent is going to be negotiating and conducting transactions on my behalf. How does a payment processor even authenticate an AI?
This is the absolute frontier of technology. We are moving from AI that optimizes the background like Revenue Boost to AI that actively acts as the consumer.
Which is crazy to think about.
What's fascinating here is that it represents a fundamental philosophical shift in the definition of a buyer. Since the dawn of human history, a commerce transaction required a human being to make a decision and hand over value. In the near future, your personal AI assistant will be tasked with executing complex workflows for you.
Like the milk example from the intro.
Exactly. You might tell your AI assistant, plan a family vacation to Hawaii in December, find a hotel with a pool, book the cheapest flights that don't have a layover, and rent an SUV. My budget is $5,000.
And then you just go to sleep.
You go to sleep. Your AI assistant scours the internet, negotiates with the APIs of United Airlines and Marriott hotels, verifies the details, and executes the purchasing decisions without your direct input in that exact moment.
The AI is legally binding me to a financial contract while I am unconscious.
Yes, but for that to work without chaos, the retailer and the payment processor need a rock-solid way to verify that the AI knocking on their digital door is actually authorized by you to spend your money.
That's the tricky part.
If an AI tries to buy a $1,000 plane ticket with your credit card, how does United Airlines know it's your AI and not a malicious bot programmed by a hacker in Russia?
Right, because the traditional way we authenticate things is biometric Face ID or a fingerprint or a password. An AI doesn't have a face to scan.
Exactly. The old security paradigms break down entirely. Global Payments is building platform-agnostic architectures to solve this exact problem. They are co-creating new commerce experiences and cryptographic handshakes with leading AI platforms to ensure that when an autonomous agent initiates a transaction, it uses secure tokens.
Like digital passports for the AI.
It is about creating verified digital identities for non-human actors. They're essentially building the digital ID checkpoints for autonomous robots to buy things from each other securely.
That is wild. They're preparing the infrastructure for a world where humans are largely removed from the friction of everyday routine purchases.
Pretty much.
So taking all this in, from the rollout of edge AI hardware in local restaurants to the invisible API plumbing of Explore and embedded payments, all the way to this futuristic realm of agentic commerce where your digital assistant does your shopping. How does management actually view the financial future of the company over the next 6 to 12 months?
Let's bring it back to Earth.
Yeah, we have to bring this back to reality. How does all this innovation translate to the bottom line right now?
That brings us to their forward guidance, which is the section of the call where management tells Wall Street what to expect for the rest of the year. Management took a very pragmatic, arguably conservative approach to revising their full-year outlook.
Because of the Middle East?
Yeah. Because of the prolonged nature of the geopolitical conflict in the Middle East and the corresponding drag on their highly profitable travel segment, they decided to proactively de-risk the back half of the year. They lowered their normalized constant currency revenue growth target slightly, adjusting it to a range of 4% to 5%.
Which is smart management. They're acknowledging reality and tempering expectations rather than hoping for a miraculous, quick geopolitical resolution to a complex global conflict. They're under-promising, but here's the kicker. And this ties back to our very first debate about share buybacks and margin expansion. Even though they explicitly lowered the total revenue expectation, they actually raised or maintained their EPS earnings per share guidance to a range of $13.60 to $13.80. That represents 11% to 13% growth for the fiscal year.
It speaks to the extreme durability of their financial model. They're essentially saying, even if the top-line growth slows down because of things completely outside our control, we are so efficient and our margins are expanding so fast that we will still deliver double-digit profit growth per share to our owners.
Wow.
And this confidence is entirely supported by their fortress-like balance sheet and cash flow generation.
Let's look at those cash flow numbers because they are massive.
In just this single quarter, they generated $687 million in adjusted free cash flow, and they expect their conversion rate for the full year to exceed 90%.
Let me stop you again. What is a conversion rate in this context? Converting what into what?
Good catch. In accounting, net income is the profit on paper. But because of accounting rules like depreciation and amortization, net income doesn't always equal actual cash in the bank account.
Okay, that makes sense.
Free cash flow is the actual tangible cash you can go spend. A conversion rate measures how much of your paper profit actually turns into real hard cash. If a company has a 90% conversion rate, it means for every $100 of profit they report on their income statement, $90 is actually sitting in their bank account as liquid cash.
That's a great ratio.
It is a sign of incredibly high-quality earnings. They aren't relying on accounting tricks. They are generating mountains of real cash.
And let's talk about how they're using that cash, because they are aggressively returning it to shareholders. As we debated earlier, they bought back 8 million shares for $550 million this quarter alone.
Right.
But they also stated they're on track for a massive $2 billion annual capital return target for 2026. $2 billion just handed back to the owners of the company in a single year.
And importantly, they're doing this while maintaining a very safe leverage ratio. Management noted their net leverage is sitting comfortably below 3.5x, and they have a stated target to bring that down even further to 3.0x by the end of 2027.
Okay, one last translation for the everyday investor crowd. Net leverage of 3.5x. I assume the X stands for times. What are we multiplying here?
Net leverage is a ratio that tells you how much debt a company has relative to its earnings power. Specifically, it's their total debt minus their cash on hand, divided by their EBITDA, which is basically their core operating earnings. So a ratio of 3.5x means that if Global Payments took every single dollar of operating profit they made and put it toward their debt, it would take them exactly 3.5 years to pay off everything they owe.
And is 3.5x considered safe?
In the highly recurring, highly stable world of financial technology, yes, 3.5x is considered very safe and manageable. Anything over 5x or 6x starts to make investors nervous.
Okay, that puts it in perspective.
To add another layer of safety, management noted that over 90% of their debt is locked in at fixed interest rates, with a weighted average cost of about 4%. So even if global central banks keep interest rates high, Global Payments is insulated. Their debt payments won't suddenly spike.
Oh, they have a fixed rate mortgage while everyone else is dealing with adjustable rates.
Yeah.
So, synthesizing all of this, all the numbers, the AI pilots, the corporate reorganizations, the geopolitical headwinds, what is the bottom line takeaway for you as you analyze this Q2 earnings call?
The ultimate takeaway is durability through diversification. We are looking at a company facing real, material macroeconomic shocks, regional conflicts, depressing global travel, shifts in airline capacity, foreign currency fluctuations, while simultaneously executing one of the most complex corporate tech integrations in history with the Worldpay and FIS separation.
It's a lot to juggle.
Yet, because of their highly diversified revenue streams, spreading their operational risk across SMB retail, massive enterprise chains, and invisible B2B platforms, and their aggressive, highly disciplined capital return program, they have a powerful shock absorber built natively into their financial model.
Yeah.
They can take a direct hit in one sector, like travel, and continue to grow their overall profitability.
And I think there is a lesson there for anyone listening. You don't have to be a Wall Street stockbroker or a hedge fund analyst to appreciate how a well-run machine handles turbulence. Whether it's a global payments giant processing billions or a small local business trying to survive a bad month, having diversified revenue streams and strict operational control over your costs is what lets you sleep at night when the macro environment gets choppy.
Absolutely. It is a masterclass in controlling the controllables. You can't control airline routes, but you can control your tech debt, your operating margins, and your share count.
We have covered incredible ground today. We traveled from understanding how geopolitical tensions on the other side of the planet physically redirect flight routes and dent digital payment yields, right through the massive architectural restructuring of a financial giant.
Been a journey.
We explored how edge AI and local computing is silencing the noise and transforming the economics of crowded local restaurants. We dug into how PayFacs and banking as a service are turning software companies into invisible banks. And we peered into the sci-fi realm of agentic commerce, where your digital assistant negotiates with algorithms to do your shopping.
It is a remarkable evolution. We are watching the digital economy mature in real time.
But I want to leave you with one final provocative thought regarding that agentic commerce piece. We talked about how global payments is building the security architecture to let AI agents buy things securely. But think about the downstream effects of that shift. Think about what happens next.
Okay, I'm thinking.
If in 5 years, even just 20% of all online purchases are made by autonomous AI agents that are programmed to ruthlessly optimize for price, efficiency, and delivery speed, completely devoid of human emotion or brand loyalty, how will traditional brands survive?
That is a staggering implication for the entire advertising industry.
Think about it. If your personal AI is doing the buying for your household staples, advertising to you, the human being, becomes completely obsolete. The flashy Super Bowl commercials, the celebrity influencer endorsements on Instagram, the sleek packaging on the store shelf, the AI algorithm doesn't care about any of that.
Not at all.
The AI only cares about the API pricing data and the logistical efficiency. Are we entering an era where corporations will have to fundamentally reinvent how they operate because they have to market their products directly to algorithms instead of human beings? How do you convince a line of code to prefer your brand of laundry detergent? It changes the very foundation of capitalism.
It really forces us to question the entire premise of consumer marketing and brand equity.
So the next time you swipe your card or tap your phone, or frankly, the next time a piece of software quietly makes a subscription payment for you in the background, keep questioning the invisible systems around you. There's a whole world of architectural plumbing, edge AI microchips, and massive global strategy hidden inside that momentary beep of an approval. Thank you for taking this deep dive with us, and we will catch you next time.